Welcome to Volume 5, Issue 20 of the Milestone Investing newsletter. And this week's ex-dividend date is the 16th of May, 2019. We have 5 companies that are paying dividends. We've got Tesco paying 400 million, Royal Dutch Shell paying 2.9 billion, Intertech paying 70 million, Glaxo 7 billion, and HSBC 1.6 billion. In total, it is basically just under 12 billion pounds qualifiable for this week. Let's see which will give us the best return on investment. This is for professionals, 29.8 for Royal Dutch Shell, to 29.7. Professionals, non-professionals, what can they expect? 7.5, 7.4. We have a valuation for this company of 204 billion. And this is as of May 2019. Now, what was interesting, but about 5 years ago, this company was worth about 100 billion. Now it's worth 200 billion. So they basically doubled their valuation, which means they doubled your valuation if you own the shares in 5 years. So in 5 years, they made 100% gain, capital gain for their shareholders, which is, for a company this size, that is not shabby at all. Okay, these guys pay dividends 4 times a year. And in the last 9 years, you would have had 36 opportunities to do a dividend fishing trade on this company. So 15 out of the 36, which is 42% of the time, had you gone long, you got your money back within a week. 7 times out of 36, 19%, it took you more than a week, less than a month. And 14 times, which is 39%, out of 36, took you more than a month to get your money back. And there were no times at all in the last 9 years when you didn't get your money back at all had you gone long. Going short, on day one for us is Thursday, on day one, 15 times out of 36, which is 42%, you would have made money on day one going short. The return on investment was anywhere between 1% and 48%. So let me just break those numbers down. Here, we're looking at 1, 2, 3, 4, 5, 6. 6 of that 15 is a single digit number. And then the other 9 of that 15 is a double digit number. Day 2, shorting on day 2, 19 times out of 36, which is 53% of the time, you made money going short on day 2. Return on investment, anywhere between 5% and 117%. 117 is clearly an outlier. The next best one after 117 is 57. So you've got 2 50%ers. And then you've got the next best after the 50%ers is 33%. That's the only one in that range. And then you've got 20%ers. You've got 1, 2, 3, 4, 5 of those. And so, yeah, day 2, it looks like the longer you leave it, when it wasn't doing so well, it was making you money. Royal Dutch Shell. Let's look at their fundamentals. What are they telling us? 421 billion was their 2014 revenues. Then it dropped to 264, dropped again to 233, and then it bounced 305, and then 388. The profit was 28 billion, it dropped to 2 billion, 5.6 billion, then it bounced up to 18 and then 35. If we look at the profit margin, we can have an insight as to what's going on here. So basically, for every £100 they made in revenue, they converted £6.70 into profit. Here, 80p into profit. Here, £2.40 into profit. Here, £5.90 into profit. And here, £9.20 into profit. So this, in terms of the performance, was their best year, because they converted every £100, 9.20 went into the profit. What they're telling us in very, very simple terms is that it's taken them 91.8 or 91 pounds of every £100 is consumed in the running of this business. 90% is consumed in the running of this business. And that's paying staff, that's paying for the overheads, that's paying for transportation to move things around, all the infrastructure, etc., etc. Companies like this are very expensive to run. They're very expensive to run. So unless you can run this with scale, it becomes a very difficult business to make work. And their margins are very thin. These thin margins can only work if your volumes are massive. They said they were going to pay 2.9, let's call it 3 billion. They're going to pay 3 billion pounds in dividends. And we can see that they, right here, made 23 billion and they've got 26 billion pounds in cash. These guys are so liquid that 3 billion to them is chump change. They can give us 3 billion and have no problem. I thought I would show you something that's interesting, actually, because based on what I said to you earlier about the valuation, so the stock market valuation for this company is 204 billion pounds. Now, that is the price that you have to pay if you wanted to buy every single share and own the company 100% outright. Obviously, if you did that, because you are buying it and you're causing more demand than supply, you are going to push the price up. But let's pretend you could do it without pushing the price up, which you can't. Let's say you could, it will cost you 204 billion. The company, if you add up all their assets, deducted from all their liabilities, they have a net worth of 202 billion pounds. This is what they call the book value. The net assets is their book value. Right? So the book value is 202 billion. The stock market price is 204 billion. So basically, the book value and the market value is the same. Now that's very rare because normally the market value is higher than the book value. It's normally higher. Again, depending on the company, but it's normally higher. But in this case, it's practically the same, which is interesting. In other words, they are not overpriced, is what I'm trying to say to you. In the last 5 years, this company has been bouncing around. So we saw in the fundamentals, they had a couple of years, 2015, 2016 was kind of low. And the share price is based obviously on the PE ratio times the profit. And so you had a low 2015, 2016. But here's the thing. The 2015 results you wouldn't have known about it until about maybe 2 to 3 months after. So we're now talking about the first quarter of 2016. You'd know about that. The first quarter, at the end of the first quarter of 2016, we'd know about these numbers. And so 2015, 2016, let's have a look what's going on. So we can see here, they're in this range, 2014, and then 2015 share price starts to dip. Clearly news is getting out that they're kind of having trouble. And then after that, they start to rise. So even though, 2016, they start to rise. So even though the profits was subdued, the share price is going up based on the future expectation that their problems were behind them, clearly. And then they clearly went ahead of themselves. So they cut in terms of valuation. So it kind of just eased off a little bit. They dropped off and went sideways for a bit, and then marched back up again, eased off, back up again. And then again, you kind of get a flat easing off. Okay. But we saw that the Royal Dutch Shell share price compared to the book value price, this company is worth what it says on the paper. So the bottom line is, you know what? That these guys are not overvalued. They're not overvalued at this level. They're good. In summary, what can I tell you? In terms of going short, nothing here is above 50. This one's above 50. That one's above 50. Okay. So Royal Dutch Shell. Miles, why didn't you highlight that one? And why didn't you highlight that one? Well, let's see in a minute why I didn't do that. And then we've got here for going long, we've got 54% for Intertech. But I've highlighted this one. Miles, you're having a bubble. What's going on here? So let's have a look at this. So let's do this one first. We're saying that Tesco is a better performer than Intertech. Why? in terms of getting money back. If we go here, Intertek in the last year, Intertek 98 days and 4 days to get your money back. Tesco, you got your money back very quickly. Now, I want to warn you that these were very, very small dividends, because they were having their troubles. Okay, and this gap here was when they didn't pay any dividends at all because of the issues they had with their accounting anomaly. Yeah, because dividends are really small here, I don't expect them to recover this quickly, this time around, this week, but I do expect them to recover in a decent amount of time. Whereas this company, this one makes this one ugly. And because of that, Intertek, even though it's 54%, it's 54% over a further, more historically distant time. Whereas Tesco's recent history. So that's why I highlighted Tesco. Let's look at these guys now. So we want to know, are these guys good for going short? So day 2, Royal Dutch Shell. Royal Dutch Shell, let's look at their performance, Royal Dutch Shell. Okay, we can see 50 days, 1 day. Well, that's troublesome. You don't want to be going short when they're doing this, when they're recovering quickly. If you want to go short, you want to be something like this: 50 days messing around, 47 days messing around, and then we can handle that. These 3, we can handle all that. But when it starts to recover quickly, problematic. Okay. But then what's the return on investment? Royal Dutch Shell, we said anywhere between 5 and 57. Do you know what? The ROI on Royal Dutch Shell going short is very good. It's good. What was the other one? The other one was this one, HSBC. All right, HSBC, for going short, this is lovely. You want it to basically take forever to recover on the upside. So all this stuff is good. But what's the HSBC return investment numbers? Oh, right, that's right. We said that 4 of them was good and the rest of them was not so good. So even though this has got a better performance in terms of messing around on the downside, the ROI is smaller. In other words, it's not as volatile. Basically, it's not as volatile. And Royal Dutch Shell is more volatile, but it has the the Usain Bolt sprinting ability. It can sprint and recover quickly. So you want to be wary of that. Welcome to Volume 5, Issue 21 of the Milestone Investing newsletter. This week's ex-dividend date is the 23rd of May, 2019. Let us have a look at what happened last week. Royal Dutch Shell. Red line is the lowest price on Wednesday. The green line is the highest price on Wednesday. That's the range for Wednesday. So we can see that towards the end of the day, it was kind of bullish, a bit like the FTSE 100. And then it gapped down. And based on the closing price, it should have gapped down to this purple line right here, just above the red. And then your exit price should have been here at 2473.8. However, what does it do? It gaps down and it gets caught up in this upward draft. And this draft literally lifted its wings and as it floated up. And you can see literally it touched the exit point for everybody who came in long at the worst price. So everybody got paid right at the end of the day if you caught it. And if you didn't catch that, you definitely got your money back on. You had the opportunity to get your money back again on Friday. Friday morning, obviously people selling off right here. You can see a big sell-off right here, a spike on the volume, people taking their profits, but the upward pressure was very strong, and it gets floated right back up again. So anyone could take their money now at the higher levels, okay? Because everything above the green line means that everybody who went long has gotten their money back. Royal Dutch Shell was absolutely brilliant for long traders. Long traders received a dividend equivalent to 28.6%. and they got their initial investment capital back 2 days later. They came in on Wednesday and they came out on Friday. Now, to get 28% in 2 days, that's not shabby at all for professionals. Non-professionals got 7%. And again, 7% in 2 days, I'm not sure many people could argue with that. That was Royal Dutch Shell. When it comes to going short, well, you know what? Anywhere between -28 and 2% for professionals, -8 and 0% for non-professionals on the short side for this one. So this was not a good one for going short, but absolutely brilliant for going long. Okay, that's all for this week. Happy investing. Take care, guys.